Good evening, guys, and welcome to today's Technical Tuesday. In this Technical Tuesday, I'm basically going to be going over how to manage a trade efficiently, understanding when to take partial profits, understanding when to move stop losses to break even, and yeah, overall have that confident bias in the sense of managing a trade. And every Technical Tuesday, I like to use examples that we did take within the week, so this meaning Monday, etc. But yeah, as the sort of weeks go on, I'm going to be updating on, very advanced concepts. But it's important we sort of have the basics in place before we elaborate on those advanced concepts. In saying that, I am working on creating videos for the subsections in the Discord that interlink with each category. For example, sponsor candle, institutional candle, liquidity, etc., and how they all align with each other ideally. And yeah, just making a video on that, and there will be more educational tabs coming soon. Just working on content right now, but yeah, a lot to come in regards to the Discord. But without further ado, let's get into this Technical Tuesday. So looking at the trade we took today, Euro USD long, the main confluences were, we did have a sweep of sell side liquidity. Again, orders being built with upon that sweep. From the algorithm's perspective, we had that rally up, that bullish rally up, small retracement, and then ever since then we have been in this sort of bullish run here. In addition to that, I was looking at this Wyckoff schematic. I believe it was this one here. So yeah, this accumulation schematic, and upon sort of reaching this level here, it looked like this was the raid price to this prior low, as explained how banks accumulate positions, etc. And this was the last point of supply plus the raid, and then we formed a mini accumulation schematic here, and then we did ideally see higher prices on that, but yeah, then got stopped at break even on that. But I just want to go over two things on the trade we took today. Firstly, the risk sentiment to it, because there's no one else that could sort of capitalize on an opportunity like this, and if it did go in our favored bias, firstly how we would manage the position, and secondly, by getting entries like this, what does it sort of illustrate? So those are two sort of things I'm going to be talking about, and yeah, the main objective for this lesson is trade management. So understanding when to take partials, when to move stops to break even, when to sort of get out of the market if something don't look right to a certain extent. So yeah, just explaining again from a more of an intraday time frame why I took this long. So we did have this 1 hour institutional candle, or is it 30 minutes, sorry. So we had this 30-minute institutional candle here, and upon forming that institutional candle, we did have that break in market structure, a micro break in market structure. So if you haven't seen the market structure PDF laid out in the Discord, that is definitely worth a read. Some very crucial information just about structure and how to play it effectively and stay safe, etc. But yeah, we did have that minor break in market structure. Upon that break in market structure, we did pull back, and in doing so, we formed this 15-minute accumulation schematic. So again, we had that 1, 2, 3 drives to the low, liquidity taken, seen that impulsive move up, and we hit our entry to the T. Now, one thing I want to sort of illustrate, some of you may got stopped out, some of you may got stopped at break even. And that simply depends on how you managed your trade. That was sort of a thing I wanted to clarify as well, is, I personally got stopped at break even, but I didn't update the group in the sense that, I shouldn't have to update you every single second. The whole point of, Quantum is for me to give you an insight on how to become independent in the markets. So I can give you the right, I can guide you in the sense that, this is what I'm looking at for an area of interest. This is a current setup I've got. I can guide you in that sense. When it comes to managing the trade and sort of your own perception, in the sense that you're seeing this play out. For example, there's relative equal highs that need to be swept. You know, you could possibly hold your position a bit longer and wait for them relative equal highs to be swept and then take partials, if that makes sense. So it's about adapting to the market regarding on what price is doing in that current moment. But just getting into a even lower time frame, so upon the 5-minute time frame, we literally got the reaction to the T, activated that limit, and yeah, we saw higher prices to a certain extent. So again, my first take profit is at the sort of previous high, right? And yes, we didn't liquidate that high, but I always use the bodies. And the reason I use the bodies is because a move or a bullish run above a body of a candle could suggest a rate. And the reason I take 20% of my position here is, let's say we risk 1%, and again we have this rally up that ideally raids this prior high here. That's 0.2% of my position already banked. If I risk 2%, that's again 0.2% of my 0.2% of my position banked, with 1.8% still running. So yeah, I always bank 20% upon raiding that first high, especially taking it on these smaller time frames, as if we look at structure overall, we were in a heavy bearish trend, in the sense we are making lower lows, lower highs, lower lows, lower highs. And notice every time there's a raiding structure and we do have that bullish run, it is quite choppy in the sense, you know, it takes quite a bit of time to get there. But when we have these sell-offs, they're quite impulsive. So it shows the momentum on Euro USD is bearish. But yeah, sometimes to a certain extent, if everything's playing out right and there are several confluences, you know, we can sort of call arguably tops and bottoms and gain a very precise viewpoint doing so. So again, this trade entry was precise, but the whole trade, obviously depending upon if you move stops or break even or not, you might have got stopped out, etc. But let's say this trade did play out to plan, and we had that bullish rally. How would I manage this trade? So firstly, as mentioned before, upon a raid of that sort of body of the candle, I would take 20% of my position here, and these are two structural highs I would like to see be broken in order for me to hold, you know, again, majority of my position. And the reason is because if you look at structure, we did have that lower low, lower high, lower low, lower high, and arguably that new lower low. And even from an hourly perspective, these are the next major engineered highs slash swing highs that need to be broken in order for us to confirm a healthy bullish trend. Unfortunately, we didn't get that break in market structure, so it shows that you know, the bullish momentum is not here yet. But in saying that, just looking at these two highs here, they are relative equal, so there may still be some bullish pressure that we can capitalize on, but not calling a top and bottom yet. Want to see further price develop within this area here, and then I will capitalize it accordingly. But yeah, going back to how I would scale this position, 20% of my position will be taken off upon a raid of that high, so that's partial taken there. Secondly, we do have this inefficient pricing, so that ranges from this candle's low to this high. So this whole price area here needs to be rebalanced with, and upon a rebalance, I'll take an additional 10%. And the reasoning I only take 10%, and this is important, the reasoning I only take 10% on a rebalance on imbalanced pricing is because the whole point of, you know, rebalancing with price is to see higher prices or lower prices depending upon your specific buyer. So for example, on Euro USD, if we did have that bullish run, the whole point of having this bullish move It's not only to mitigate with sponsor candles and clear out liquidity, etc. It's to rebalance with price. So it's very rare we see a rebalance and then a retracement. Sorry, a reversal. But retracements do occur upon a rebalance of inefficient pricing / imbalanced pricing. So upon rebalancing with that price range and having that retracement, it basically, from a psychological aspect, there's less position currently running. So pullbacks and all of that, it's much more easier to deal with, in the sense that we can, expect a pullback, knowing that we've retained 2 sets of profit now. So 30% of our position has been banked on 2 different levels. And yeah, continuing that bullish rally, we do come into a 1 hour sponsor candle. Now, upon coming into the sponsor candle, what we could see is, again, this is a key sponsor candle, and the reason I say that is because we rated this prior high. We did have these continuous doji candles, and then seen a major bearish candle follow. So from this candle alone suggests a lot of bearish volume has been built with those last up candles before the down move, making it a very valid sponsor candle. So depending on your preference, this is another area to take partials. And when I say depending on your preference, I mean regarding in percentages. This could either be a 20% partial you take off, or a 30% partial. So depending on how strong that sponsor candle looks. And again, we had a sweep with these prior engineered highs. So I would personally take 30% of my position off, but if you want to scale your position a bit more and hold as much capital in the market as possible, which is not the best way to go with it, because at the end of the day, the only profit that matters at the end of the day is the profits that you've retained, from an actual balance point of view. There's no point you trying to swing for the moon, and there's no structural level in taking partials, etc. Partials is how you're able to bank profits and ideally withdraw at the end of the month. If you sort of just swing for the moon and hold, yes, to a certain extent we can reach our target, but from a psychological aspect, it's always going to be in the back of your head, as in, what about if we get a reversal from this point? So upon looking at these reversals or points of interest, for example, this imbalance is a point of interest of mine. Upon rebalancing it, we could have that reversal that's expected. We could have a retracement that's expected. So upon looking at that zone, I would understand, how does this reflect? How does this have a reflection in the market in my specific bias? So I have a bullish bias. If we do get a rebalance of that inefficient pricing, I'd expect higher prices. So minimal sort of percentage will be taken off in that level. For example, over here, this is a very valid sponsor candle. So we could actually see a reversal, considering if you look at market structure, lower low, lower high, lower low. This was the next lower high. So we could ultimately form that new lower low if we reach this pricing and this trade was successful. So I ideally personally take 30%, but if it was any other sponsor candle, I would stick to that 20% rule. Then my next partial profit taking is at the second point of the trend line and the next prior high. So if we actually look at this trend line in a bit more in depth, there's 2 sort of second points. Arguably you can consider that one as one, and the reason I'm sort of classing out this one is because we had a mitigation of that candle there with this wick. So now it's basically become an engineered high that needs to be raided, and upon raiding that, we can see similar price action to this, in the sense we have a wick above that and then ultimately reverse. So this is another area of interest of mine, and what that's basically done is it's taken out buy side liquidity, or people that had stopped above this trend line here, and ideally stops above this prior high here, maybe sold short upon a retracement, etc. From a 61.8 or whatever retail trade from regarding Fibonacci, upon a raid of that high there, and sell stops, stop losses, etc. being gathered, and then we see an ultimate sell-off, this in my head could signify a reversal, in the sense that now the objective is done. The liquidity from the trend line has ultimately been gained from this high, and we could ultimately be looking for lower prices. So it helps a lot. It basically makes trading stress-free, in the sense you're taking partials from different areas, and you're basically, you know, allowing trend to continue healthily. And then yeah, we could take an additional amount of profit at this prior high here, but upon, you know, taking profit on that second touch, that's third touch of that trend line, I would look to hold the rest of my position until it gets to this area of interest here. So if I go into the 4-hour time frame, this is our 4-hour area of interest, and the reasoning is because it's the last up candle before the down move, creating that a 4-hour sponsor candle, and we would have had a clean raid of this trend line liquidity here. So again, there's two things I would do here: either take full profits, or the reason I've considered it as an area of interest and not necessarily a sponsor candle as such is because I would wait to see how price reacts off this level. Do we get a raid above this high to activate orders and then look to sell off, or do we break market structure impulsively and then I wait for a pullback and then look to go short? But yeah, upon reaching this level, that's the first thing I do, is wait to see how price reacts on this area of interest, and then I could ideally look to hedge my position. Now, hedging is beautiful in the sense, if we still have this long running and ideally this is a reversal trade, you know, we could capitalize on quite a huge amount of movement. So just scaling back, even this sort of area here, it's in line with that sponsor candle there. But ultimately now we know it's a reversal trade, and we can start looking for higher prices upon getting stopped at that sponsor candle there. So yeah, that's just a bit about how to manage a trade position. Obviously on this occasion it weren't successful, as you know, this bearish institutional order flow is continuing, and it looks like we are just majorly going to sell off. But ultimately I am looking for a retracement. If I just sort of clear up this chart a bit, so yeah, always mapping out market structure sort of levels as well. But as we can see, that was this sponsor candle there. Yeah, that's what we could be looking for in a deep discount range there. So arguably that is a you know, 200. Oh no, 1 to 100 arguably, yeah. But even for our initial target, which was, I believe, right around here, this was a 1 to 61, I believe, or 1 to 60. 1 to 61, and I'll basically want to put that sort of level in perspective, in the sense that from our entry, this was a 2.5 pip stop, and this is basically something I use to calculate my lot sizes and you know, the amount I should risk, etc. So let's say you know, average people sort of trade with a $1,000 account, and your risk percentage is, you know, let's say 1.5%, which is an average sort of risk to be taken in the markets, and your stop loss is 2.5 pips. So again, we can trade with a 0.60 lot. Now that's a massive lot for a £1,000 account, and if we sort of do the maths on that, and that's a 0.6 lot with a, I believe that was 150 pip take profit. So 150 pip take profit, so 6 times 150, that's arguably a £900 return if you let the position swing. Now, considering we're taking partials, you know, ideally move it trailing stops, etc., we could still be looking to bag $650, $700 just on that one trade, and that in itself is a tremendous return on a 1k account. So yeah, that's just a bit about lot sizes. And those of you who are funded by FTMO, 100k, and I'm not sure, I believe I talked about this in a previous Technical Tuesday, but I'd never risk 1% on an FTMO account. I normally risk about 0.25%. So again, that's an equivalent to 10 lot. Sorry about that, the mic cut off, but just referring back to my point, those of you are funded by FTMO, and more specifically the $100,000 account, the risk sentiment for me is the main thing in surviving the market. People are going to risk, 1%, 1.5%, arguably that's 15% per trade if you look at it in a realistic format. But if we risk 0.25%, it's an equivalent to a 2.5% risk. And the reason I say that is because the 100k account is really looked at as a 10k account, as the maximum drawdown you can have on FTMO is 10k before it gets violated and they take the account away from you. So risk is the only thing traders can control, and it basically allows us to stay in the market for as long as possible. And by refining to these small stops, we can gain a massive change in both a revenue status and a lot size. So for example, a 10 lot is unheard of, regardless if you talk about 100k FTMO or sort of any account size. You don't really see many people trading with 10 lots, but when you put in perspective with our trade there, that's a 2.5 pip stop for only a 0.5%, only a 0.25% risk. So ideally, if this hits take profit without no partials or nothing, that's gonna basically calculate to 15,000, as the 10 lot is equivalent to £100 per point, and this is a 150 pip take profit. That's equivalent to about 15,000. Along taking partials on the way, we're still looking at that 12-13k mark, all in all, or maybe a bit lower, 12.5, maybe hitting the 11, but it's around that region there. Again, you sort of have to calculate it as an overall perspective, but still that's a phenomenal return for just a intro week position. But yeah, let's say you had the 10 lot on here and you had that 20 pip move. So again, that in itself is 2,000, and that took 30 minutes, and yeah, arguably under 2 hours, or arguably under an hour and a half, you just made $2,000 by just refining your stops, understanding exactly where price might reverse off, and capitalizing on that trade. But yeah, that was an example on how to efficiently manage a trade. This trade was a bit risky in the sense we were trying to catch the bottom of this trend. If we did catch the bottom, you can understand how favorable our bias would have been and the return that we would have got on Euro USD. But nevertheless, there are currency pairs that I'm looking at for the rest of the week. Gold being one, NZD USD, AUD USD, couple other ones, GBP USD I've got my eye on as well. We did have a sell-off, but I am expecting a small retracement up. But nevertheless, if we sell off straight to our 4 hour area of interest, which is my bullish bias, which is the main bias, as that's in trend with the daily time frame, weekly time frame, and monthly time frame, meaning we are going to witness an impulsive move off that. So yeah, there's a couple other positions I'm in. We did take this one and Euro GBP, so arguably if you did get stopped out on both, we are minus 2% for the week. But yeah, this is very early in the week. Wednesday we have got some high impact news, so if you haven't seen the market outlook yet, do go over that as I talk about everything from the monthly down and understanding how sort of news can be the catalyst to some currency pairs for the month ahead. So yeah, that was about how to structure a trade, how to manage a trade efficiently, and I hope that clarified or cleared a couple things that maybe you had a bit of confusion on, or were stuck on. Again, thank you very much for watching this video. If you do have any questions, please let me know. And yeah, let's end this week on a good note. Thank you very much and have a good night.